Hello, everyone. My name's Matt Rice. I'm the Chief Investment Officer at First Business Bank Private Wealth, and I'm really excited to talk to you today about our 10-year capital market assumptions. As we talk about here, what is the purpose really of these capital market assumptions? Really, first and foremost, they're really designed to drive our strategic investment decisions over time. And really, also, as a part of that, we want to provide you some transparency to the building blocks kind of behind our investment decisions. We want to help frame for you our expectations about portfolio returns and risks. And then we want to keep you focused really on the long term objective. Sometimes we get caught up in the short day-to-day machinations of the market. And sometimes I think, we're asked to sometimes explain every wave in the ocean, when in reality, we want to be focused more on really what are we trying to accomplish over really a full investment period. Before we dive into the capital market forecast, individual asset class by individual asset class, here is just a summary of all of them on one page. You can see at the upper left, really cash all the way down to alternative investments, just from a 10-year perspective, our expected arithmetic return, our expected geometric return, and really our expected standard deviation. And then on the right side, the orange, yellow, and green, these basically show correlation coefficients. So the greener areas represent asset classes that tend to kind of move with each other over time. So you can see that there's kind of a darker green for like large cap, U.S. equity all cap, and U.S. equity large cap. Then you can see other asset classes, really there's more of a red or an orange, and those are asset classes that tend to have negative correlation to one another. So with that, I'll continue to move, and we've got here a slide that just illustrates the same data, but on a graph, return on the vertical, volatility on the horizontal. You can see really the green asset classes here represent our 10-year forecast for fixed income categories. The purple represent the equity categories, and then the orange represents some alternative investment categories. Really diving into the building blocks method that we're using here. Inflation is not an asset class, but it is really an important part of kind of the inputs or building blocks to our capital market assumptions. And so what we do really here is we look at the break-even rate between the 10-year Treasury inflation protected security and the 10-year nominal. So if you look at those, the difference, you have a 10-year Treasury that might have a certain yield associated with it, and then you'll have a Treasury inflation protected security which promises to pay you a certain rate of return plus inflation. And if you look at really the difference in those yields, the difference in those yields should be the implied expectation of the market for inflation. And that's really generally what our break-even or what our inflation forecast will be. There's certain periods of time where we may deviate from that, periods like you can see here, the 2008 period, and even during the pandemic period when there was a bit of a flight to liquidity during certain financial crises that caused, we thought, a bit of a disturbance in this relationship. But as you can see right now, looking forward for the next 10 years, our expectation is for inflation to be 2.23, which is consistent really with that difference between the 10-year nominal of 4.37 and then the 10-year tip at 2.14. As we continue to look at the presentation here, we've got cash as really our first asset class. We're doing a 10-year forecast for cash, but cash is a lot easier to forecast over the next 3 months because it comes out every 3 months. There's a new 3-month T-bill. As of really the end of November, we saw the T-bill at 5.45. So that's a pretty good forecast for the next three months, but perhaps not for the next 10 years. Generally, what we're showing here in this graph is a relationship between the cash yield over time and really inflation over time. And we can see, on average, you can see over time that the T-bill has been the average T-bill minus inflation has been slightly positive going back here to 1950. But you can see that through most of the last 20, 25 years here, it's been in that negative, slightly negative type of space. So what we're looking at essentially with this 10-year forecast is we're going to make the assumption that between now and the next 10 years that cash will return to a negative real return. So it'll start out at 5.45, which is a positive real return expectation, but over time it'll trend its way down to 2.23, which is our expectation about inflation over the 10-year period. And so when you average those two together, you get a 3.84% return assumption for cash over the next 10 years. Really looking at Treasury inflation protected securities tips. It's really one of, in our opinion, one of the true risk-free assets out there, because even nominal treasuries, if you have a nominal treasury issued with a 4% yield, you still have the risk that inflation ends up being higher than 4% and you end up losing money. With a Treasury inflation protected security, on the other hand, it's issued with a certain real yield associated with it, and then the return will be higher if inflation is higher. It'll be lower if inflation is lower. So it's a great proxy for kind of how the market is viewing real interest rates over time. And we can see here, this history, the 10-year real yield over time, it's kind of been close to just under 1% really positive over the last, call it 20 or so years. And then during the pandemic phase, you can see that this real yield actually got significantly negative. So if you owned a Treasury inflation protected security, it might pay you inflation minus 1% during the 2020-2021 period. Now, with the environment that we're in, with interest rates rising, real interest rates rising, we're expecting really the Treasury inflation protected securities index, or Treasury inflation protected securities, to pay us 2.2% plus really the expected inflation rate. And so when you kind of add this together, 2.23 plus 2.36, the TIPS returns, as you can see in the sixth bullet point there, that gets us to a 4.64% return for the next 10 years. As we continue to work our way through the presentation here, we have U.S. investment grade intermediate bonds here. This is kind of your traditional, we call it Bloomberg U.S. Aggregate Index. This is one of those asset classes that's actually, it's been surprisingly easy to forecast over the last number of years. If you just take a look at the yield to worst, as we call it, kind of factors in some optionality into bonds. But essentially, the current yield of a bond index is a pretty good predictor, in this case, of what the next 10-year return will be. So if you look at this regression in the bottom left-hand side, and you see these all these little yellow triangles, and then you see this dotted line connecting them, that dotted line is really the best fit regression line. So we look at that dotted line represents really close to 95% explanation, or 94% explanation. So the current yield explains about 94% of the return for the next 10 years when you look at things historically, really going back to, all the way to the 1970s, late 1970s. So that's a pretty good explanation. And then on the far right here, you can see a combination of the 10-year return, which is the dark line, and then the yield to worst. And you can see the little gray bars there that represent really the error term in this particular forecast. And you can see it's pretty small. So with that being in mind, the current yield to worst of the Bloomberg U.S. Aggregate Bond Index is about 5.05%. With that, that's about our expectation, or our best unbiased view of what we think U.S. investment grade intermediate bonds will deliver over the next decade. When we look at short-term fixed income here, really short-term fixed income, we just combine our cash forecast with our investment grade intermediate bond forecast to the tune of about 2/3 bonds, 1/3 cash. That's a pretty good blend for about a 2-year duration type of mix. That gets us to about a 4.65% return. Then we have municipal bonds. This looks probably very similar to what we saw for the U.S. investment grade bonds. So we can see here that the explanation of this just line of how well does current yield explain return? It's about 89%, so not quite as high, but still very, very high. In this particular case, we're showing a boosted return. What do we mean by a tax-boosted forecast? Well, in reality, our muni forecast might be 3%, but in munis, you don't pay federal income taxes. And so if you're in the highest income tax bracket of 37%, you really can divide 3% divided by 1 minus that tax bracket, and that gets you kind of the tax boosted return. So you could, if you earn 4.8% and had to pay taxes, it's essentially the equivalent of earning 3% and not having to pay taxes. And so that's what we mean by that tax boosted forecast, just kind of comparing it a little bit to other taxable fixed income categories. Then we have here high yield muni bonds. In this case, with anything that's high yield, there's that higher probability of default or that you're not going to get repaid. In this particular case, we have a regression analysis or regression here that kind of shows about a 77% explanation, so not quite as high as some of the others. But generally speaking, when yields get higher, there's kind of a higher probability that you might not get paid back everything, even in the muni bond space, even though defaults are relatively low in munis, at least they have been historically. So with this, kind of factoring in this particular model here, this leads us to, a current yield to worst of about 5.8, leads us to really a 4.7% return going forward. And of course, when we tax boost that, we get a very nice 7.46% return that's effectively boosting it to kind of equivalent. So if we earned a 7.46 and had to pay taxes on it at 37%, that would be an implied 4.7% return. Then we have here high yield corporate bonds. The yield to worst really in this index was 8.4% as of the end of November. With that, we can look at the same type of regression analysis here. Here we're getting down to closer to a 48%, or an R-squared of 0.48, which means this model explains about 48% of returns. So a little bit more uncertainty here in the forecast for high yield than some of the other fixed income categories, as you might expect. So in this particular case, kind of implied in this particular model is a drag or a loss of 1.7%. And so while the current yield might be 8.4, kind of embedded in here is the assumption that our return is going to be about 1.7%. So that's sort of factoring in, a loss over time. And if you kind of think of it, well, assume for a minute that, recovery rate, if there is a bankruptcy or default, is 50%. And we have the drag, we essentially have a 1.75% drag associated with it, then that's about a 3.5% loss, 3.5% default rate. So if you have a 3.5% default rate and a 50% recovery rate, that's one way you can get to a 1.75% sort of drag. And so kind of embedded in this, the assumption is that when credit spreads get higher, yes, you have a higher expected return going forward, but you also have a higher probability of a larger drag rate hitting your portfolio. Here's just another slide, high yield bonds, showing kind of the model versus the prediction over time. There are certain areas when the model was spot on, others where there was a little bit more error associated with it. But overall, we think this is really the best unbiased kind of forecast for high yield bonds. Then we have bank loans. Bank loans, are a little bit unique as an asset class perspective. They tend to float. So as short-term interest rates go up and down, much like money markets, bank loan yields go up and down. So they tend to float a lot more. Kind of embedded in here in the bank loans, a lot of these bank loans are high yield companies. So with that, we expect bank loans to kind of go up and down with money market yields over time. And we also expect there to be some loss that occurs in bank loans, as not all bank loans get paid back, unfortunately. So from there, we're using a lot of the same high yield bond assumption here of a 1.74% kind of bond loss. We're kind of factoring in a bit of that same mean reversion that we used for cash. All in all, we go from a 9.79% yield to maturity as of the end of November to a forecast of about 6.4% or 6.39% over the next decade. Here we get to the equity side. Equities a little bit more interesting maybe for some than fixed income. And one of the best predictors of the stock market return going forward is simply where are we at from a valuation today. And so this model here shows on the horizontal axis our current price to earnings ratio. And then on the vertical axis, it shows the next 10-year annualized rate of return. And so what this tells you is when you have, in the upper left, low historical valuations or low valuations by historical standards, your returns tend to be higher over the next 10-year periods. Conversely, when you get to high historical valuations of periods of high, like 1999, call it, typically those come off of really good 10-year periods. The next 10 years are not so great from a valuation perspective and a return perspective. So if you look at that, you can kind of get an idea of where we are. And if you look at the yellow circle there, that's November 30th of 2023, kind of where we were from a price to earnings ratio perspective. we were right around 21 or 20.98. You kind of look at that from a valuation perspective, and you kind of use that regression best fit line. That gets us to a forecast of 6.64. So we're a little bit on the more expensive side of average from where we've been on a historical basis, but we're nowhere near kind of where we were in those late 1990s, those kind of tech run-up periods. And if we look a little bit more at this, there's a few other points here I think that are interesting to look at. I plotted here, kind of missing in this analysis because we don't know what the return would have been for like the last 10 years, but this would have been the prediction of this model in terms of a 10-year forward-looking return. So if we went back to the end of 2020, you might remember that, right? We're in the midst of the pandemic. The stock market's going crazy. There was a big upward return towards the end of the year. Valuations got very, very high. Kind of baked into that would have been an assumption of a 2.5% return for the next decade. Of course, since then, we had over a 20% plus bear market that kind of wiped out some of that overvaluation. And you can look at where we're at now, closer to that 6.6%. Going forward. Actually, a year ago, if we'd have done this at the end of 2022, we'd have been closer to 9.6%. And so this run-up that we had in the last year, this really significant run-up we've had in U.S. equity markets, kind of took us from a 9.6 forward-looking return up to a 6.6. And so we do expect there to be a good deal of variation year over year here with kind of our implied forecasts. So if we look here at the next slide, this is really the model versus its prediction. So we have here the dotted line is really what the model is predicting the return to be. The thick line here is the period, the actual 10-year return, and this goes back to 1958, as you can see. And there's a pretty high level of correlation between these particular numbers of prediction and actual returns. And if we look here at U.S. equity, all large, mid, and small, so what we did is we used this methodology developed by some guys named Black and Litterman, called Black Litterman. Surprising where what we're doing is kind of reversing portfolio optimization. So instead of starting with our expected returns and optimizing for the ideal portfolio, what we're doing is starting with the market portfolio weights. In this case, market's about 70% large cap, 20% mid cap, and 10% small cap. If we assume that portfolio represent what we call mean, variant, efficient mix, portfolio theory then can backwards, we can optimize or solve for the implied returns that are embedded in the market there. And so when we look at that gets us the all cap, mid cap, small cap. And so we have a large cap expected return of the S&P 500 of 6.64. Mid cap is 6.98, has higher volatility. Because it has higher volatility, in order to be fairly valued, it would have to have a higher rate of return expectation, or nobody would invest in it. That wouldn't be 20% of the market. Same with small cap. In order for folks to invest in it, it would have to have a return of 7.2, because if it didn't, it would be, it wouldn't be worth 10% of the market. Which it is. So that's essentially the theory behind Black Litterman. And we look at the same Black Litterman approach. Once we have a U.S. equity, we can look at international and emerging market equities and figure out what's implied. So if we take a look at the market as a whole, the global equity market is kind of looked at by the MSCI ACWI. It's about 63% U.S., about 27% international developed, and just under 11% on the emerging market side. That theoretically should represent, in a theoretical modern portfolio theory sense, the mean variant efficient portfolio, which means that's the portfolio you invest with that eliminates all kind of non-diversifiable risks. And so if we can plug in, well, if we think we know what the U.S. equity return is, we can tell the computer to solve for us the implied international and emerging market returns, given that the overall market has those weights. And if you look at that, the U.S. equity all cap gives us 6.8%. International, because it's higher volatility, we need a higher return of 7.79, or no one would invest in it. Same with emerging markets, because it's higher volatility, needs an 8.48%. In our thinking, we do think that there's better opportunity from an overall pure return perspective outside the U.S. than inside the U.S., just given kind of where valuations are at. We've gone through a long period where U.S. equity has dominated, and we think generally, when you look at markets over time, there is these, after 10 plus years of one market dominating, there's often a mean reversion that occurs. Where we see potentially geared up to see international emerging markets potentially start to outperform over the next decade. However, we don't think the outperformance is going to be quite as high as what the implied market caps weight. There's a lot of uncertainty in the world, call it war in Europe, uncertainty particularly in Asia going forward, some activities on the part of China and others. Just looking at kind of where we think things are going, looking forward, we trim back some of those returns a little bit. So our international, what we're doing is we're a little bit underweight within international, a little bit underweight by about 5%, both international and emerging. And we look at what the implied returns are for that. It's about 30 basis point lower on the international, so 7.49 instead of 7.79, and about 40 basis points or 0.4% lower on the emerging market of 8.08 than 8.48. So embedded in here is we still expect that international and emerging are going to have higher returns than the U.S. over the next 10 years, but we don't think the magnitude is quite enough to justify the added volatility there. So that's why we have these strategic underweights within the international space. Modest strategic underweights, but underweights nonetheless. As we continue to work our way through here, here's just one slide that sort of illustrates all of the equity categories all together. Global equity, 7.4%. U.S. equity, 6.8%. Large cap, 6.6%. Mid cap about 7, U.S. Equity small cap 7.2, non-U.S. equity. This is a little bit different than just international developed because it includes a blending of about 75% international developed and about 25% emerging. That is 7.92. And then we have international developed equity of 7.49 and emerging markets of about 8.1. Again, this 7.92 is really a blend a little bit of the international developed equity and the emerging markets. Okay. As we continue to work our way through the presentation, we have real estate, REITs in particular. One of the ways we can look at real estate is real estate tends to be dividend return plus the expected increase in REITs over time or rents over time. And we approximately expect really rents to increase to the tune of inflation over time. And so with that, we can combine the current real estate dividend yield of 4.2% plus our inflation forecast 2.2, that gets us a 6.4% return. Commodity futures, if we look at our commodity futures are essentially forward contracts on commodities that are rolled over periodically. In this particular case, we're looking at the Bloomberg commodity index. With this, what happens is we have a cash as a component of the return because if you look at commodity futures contracts and an index, the assumption is that you have a bunch of cash and you use that cash to collateralize these forward contracts. And so with that cash, you can earn a 3.8% return because that's our forecast for cash. And then we expect really over time commodities to increase by the tune of about inflation. And commodities over time are going to increase with inflation of about 2. And then we're estimating here over time throughout long-term history, sometimes usually there's a positive roll return that happens. There's a natural hedger and speculator and you put them together and the hedger's willing to take on a lower rate of return in exchange for risk mitigation. The speculator is willing to take on the risk with the idea of getting a higher rate of return. And over time, oftentimes there's an expected positive risk premium associated with that. We're going to be conservative here and just estimate no roll return whatsoever, that the roll return is 0. And that's where we get to a 6.07% commodity return forecast. Again, commodities often are in portfolios because unlike pretty much any other traditional financial asset class, commodities like unexpected inflation. When there's unexpected inflation, commodities tend to do well, stocks and bonds don't do so well. So while commodities might not have a high overall expected return and they might have high volatility, the reason that they're often owned in portfolios is that they zig when everything else zags in a portfolio. And that certainly has been the case for, if we took a look, for example, at the 2022 period when we saw significant negative returns out of stocks and bonds when inflation was on the rise, we saw commodities outperform during that period. Then we look at really a liquid alternatives portfolio. This is really customized to some of the portfolios that we built. Just looking at the volatility budget that we're targeting for these of a 3.4%, we just took a look at that and said, well, if we invested in a portfolio of cash and equities, what blend would get us to a similar volatility? In this case, it would be close to 78% cash and about 22% large cap U.S. equities. That gets us to that same 3.4%. So if we take a look at that portfolio would give us about a 4.67% return. When we're investing in our liquid alternatives portfolios, we expect them to add some additional value above that from an alpha perspective. Alpha meaning excess risk adjusted return. And so that's why we're going to add a 1% expectation for expected excess return over and above that 77.5 and 22.5% portfolio. So that concludes really our capital market assumptions. We're again proud and humbled to work with all of our clients. We thank you so much for your business. We're looking forward to reaching out to you, our portfolio managers, our wealth advisors, our trust advisors, talking to you about our capital market assumptions, how we're incorporating those into your investment portfolios from an investment portfolio construction perspective, from a financial planning perspective. These capital market assumptions really are going to be the drivers of what we're doing from an investment perspective and also from a planning perspective. And with that, we welcome your feedback. We welcome the opportunity to continue to engage with you. And again, thank you so much for your time. I really appreciate it. And take care and have a wonderful day.
First Business Bank, member FDIC.